Hi, I'm Byron Udell, founder and CEO of AccuQuote. Today, I want to share a secret with you. The life insurance companies are praying that you don't learn about the little-known but painfully obvious secret of how to win the game of life insurance. The fact is, most people lose the game, and the life insurance companies need to keep it this way. Now, I'm going to share the secret with you. It's not about how much you pay or what kind you buy or even who you buy it from. And if you're thinking the secret only works with certain types of life insurance, that's also not the case. The secret can work with any kind of life insurance. So why would I share the secret with you? Well, I'm actually hoping that once you know the secret, like hundreds of thousands of other people that have trusted us to handle their life insurance, that you'll do the same. So let's get right to it. You're probably wondering what I mean when I say win the game of life insurance. That means the consumer, you, comes out ahead and the life insurance company doesn't. In other words, you as the policy owner will end up making money when it's all said and done instead of losing it. Now, about the secret. The secret to winning the game of life insurance is actually very easy if you know how. And it's going to sound simple and obvious. It can be summarized in just 6 words. So here it is. Die with your policy in force. Now say it with me. Die with your policy in force. Sounds easy, right? The odds of death, in case you don't know, are 1 out of 1. And I'm pretty sure you can handle that. So why is it that so many people don't win the game? Why do so many people lose the game of life insurance? We all die, so it's obviously not because they don't die. They lose because their policy lapses before they die. Now, this can happen for a myriad of reasons. Sometimes it's because they no longer want the policy. Maybe they're divorced, so they intentionally drop the policy. Sometimes it's because they run across tough times. They lose their job and have some difficult decisions to make, like, should I feed my kids or pay this life insurance bill? I don't know about you, but in that situation, I'm feeding my kids. Another reason why policies lapse is that people move and forget to tell the insurance company they moved, so the premium notice never gets there and people just forget about it. The bottom line is that the insurance company doesn't care why they lapsed. They collected premiums for years and don't have to pay a claim. In other words, they won and you lost. Let's do the math. Say you bought a 20-year term policy at age 40. Your premium is $892 a year. At age 60, the premium goes from $892 to $26,000 annually, and it goes up every year thereafter. That's a real example. I'm not making this stuff up on the fly. So what do you do when you get that ridiculous premium notice? Of course you'll drop the policy. Who would pay such a ridiculous premium? The insurance company keeps your 17 grand and you get nothing. Let's look at another example. You buy a guaranteed permanent life policy at age 45 with an annual premium of $8,000 with all the best intentions. At age 55, 10 years later, since maybe your wife left you or your kids are all grown up, you don't want to keep paying the premium, so you drop the policy. The life insurance company will keep your 80 grand and you get nothing. These are real scenarios, and these are classic examples of how people lose the game of life insurance every single day. And the profits the insurance companies make on all these lapsed and expired policies actually subsidize the ridiculously high rates of return for the people smart enough to continue to own their life insurance and die with their policies in force. Now, I said earlier that the secret can work with any kind of life insurance. Of course, from the examples I just gave you, you can see that you can also lose the game with any kind of life insurance. So can the secret work with term insurance? Yes, it can. But in order for it to work with term insurance, you'd have to do something you might not want to do. You'd have to die before you're supposed to. And dying young is obviously not a great plan. Now, what about permanent insurance? It costs more than term, but it does have a level premium for the rest of your life. So what's the rate of return on a permanent policy at death, at life expectancy? Well, that depends on when you buy it, what your health is, and when you die. But let's look at an example. I recently bought a policy at age 55, $1 million of coverage at a price of just over $10,000 a year. Assuming I live to, say, age 85, I will have made 30 payments of $10,000 for a total of $300,000. My family will receive $1 million tax-free for a gain of $700,000. That's an after-tax rate of return of over 7%, and that's a pre-tax equivalent rate of return of well over 11%. And that's a conservative, fully guaranteed contract issued by a multi-billion-dollar A-plus rated financial institution that's been around for over 100 years. And remember, that high rate of return is if I die when I'm supposed to. If I die early, then what I have is more like a winning lottery ticket, except it's all tax-free. The returns are astronomical. When I bought my policy, I also tried to fathom a scenario under which I could live long enough to turn the policy into a bad deal. The fact is, I can't. Even if I live to 100, I still win the game. And while each case is different, unless you're really old or really sick, if you buy a life insurance policy and die with it in force, you're going to win the game. So I have to ask you, in today's world of zero interest, where else can you go and get returns this high without taking any market risks? Now, after hearing this, some people ask me, how can the life insurance company make any money on a policy where they're returning a 7% rate of return if you die when you're supposed to, and an astronomical rate of return if you die early, especially when they're only earning less than 5% on the premiums you're paying? Well, in case you weren't listening, they don't make any money on those policies. Again, if you die with your policy in force, the insurance company will lose money on it. The people who buy and drop their policies prior to dying are subsidizing the returns for those who are smart enough to die with their policies in force. Look at it like this. The losers pay the winners, and the house, the insurance company, takes a small cut. I know it sounds crazy, but it really is that simple. Here's the bottom line. To win the game of life insurance, you have to own a policy that you'll be able to keep until you die. Now, for most of us, that means a policy with an affordable, predictable, and level premium for life. Here's another question I get asked all the time. Why do so many wealthy people buy large amounts of life insurance when they clearly, or at least ostensibly, don't need it? The answer is simple. Wealthy people are usually pretty good at math. They've crunched the numbers and figured out that if they just make sure to hold on to their policy until they die, the rate of return on their premiums at death will be higher than any other safe conservative investment they could make. In fact, it'll probably beat some of the more risky investments without having to take the risk. To wealthy folks, it's just another asset class. Let's face it, every investment advisor or money manager on the planet always recommends diversification. In short, that means not putting all your eggs in one basket. They say you should own stocks, but not one stock. And don't just own stocks. You should own some bonds too, perhaps some real estate, precious metals, maybe even some cash. And if it's all done just right over time, your returns should be steadier and everything should work out in the long run. But what if you die early? What if you die before your time? No one expects it to happen and we don't want to think about it, but it happens to people every day. Time, then, is a key component to the success of the plan. Your portfolio may be diversified against a whole bunch of different risks, but many of those will never come to pass. Remember, though, death is a risk, and unlike the others, death is a certainty. Doesn't it make sense to diversify your portfolio against the possibility that you might die early? I call this time diversification, and guess what? They don't teach this in business school or anywhere else for that matter. When I bring up time diversification with money managers, their jaws drop and a light goes on. The fact is, if you die young, there's simply no asset class that'll even come close to outperforming a life insurance policy. And if you die when you're supposed to, around your life expectancy, the rate of return is still around 7% after tax, which is a 9 to 12% pre-tax equivalent. And that beats virtually every other safe investment on the planet. So that begs the question, should you consider taking a small slice of your portfolio and diversifying it into life insurance? Now that's up to you, but I know I did. At AccuQuote, life insurance is what we do. We live, eat, breathe, and sleep life insurance. I've been on the radio and TV for over 2 decades talking about how important it is, and I'm regularly called upon by the media, including the Wall Street Journal, USA Today, CNBC, the New York Times, and Kiplinger's Magazine, to comment on life insurance industry issues. I'm passionate about helping every single person I can protect their family with what I believe is the most important product mankind ever invented, with the possible exception of the wheel, of course. That's right, life insurance. If you think that sounds crazy or you think I'm kidding or exaggerating, I'm not. This stuff is that important. I sometimes wonder what people did before it was invented. The choice is yours. If you're going to own life insurance, you're either going to win the game or you're going to lose the game. We want our customers to win. We'll show you how to win and give you simple and easy ways to make that happen. We have access to dozens of the top-rated life insurance companies you know and trust. We compare their prices, features, and financial strength, and we'll give you meaningful recommendations to consider. And we do it all right over the phone. Bottom line, we save you time, we save you money, and you get to skip the 3-hour kitchen table face-off. Since 1986, we've helped millions of people save a fortune on their life insurance. As always, it'll be up to you as to whether you decide to take our advice. Thanks so much for listening, and I hope this was helpful.